I would say right now what the general sentiment is of everyone that I'm talking to is that there is going to be a short-term correction while the Fed kind of raises interest rates, potentially oversteps in raising interest rates before they pull back on that. And they could not be more excited about the long-term prospects for Tampa Bay and for multifamily in Tampa Bay.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, the winds, they are changing.
The winds are changing, and so it's really been an interesting...
Is that really fair? Are they really changing? Are they really... There's some maybe a little cool wind blowing in.
I don't know, Eric. All I know is like when you're there, I prefer not to be downwind. I'll just go the other side. But anyway, it has been an interesting period. We were all expecting an increase in interest rates and
inflation,
and inflation's going on, and now it's happened. And when you think of the increase in interest rates, the elephant in the room in commercial real estate is multifamily. And so it's a good idea now to try and get an assessment of what's going on in the multifamily market.
Yeah, I mean, we've had a number of questions about what our thoughts were, folks we're talking to, what their thoughts are on what's going on with the market. You know, multifamily is the 800-pound gorilla that is in the commercial real estate space, and that's the one that's they're sort of the canary in the coal mine for what's happening for the rest of the commercial real estate industry, particularly with Florida. Is the economic driver. It's easy to sort of follow what's going on with the investment in the multifamily space to see how it filters through the rest of the economy, because it has so many implications. It's the rents, and it's not just sales, it's the rents, it's what's happening with those increase in rents and what's happening with salaries, et cetera, et cetera. And so it all kind of ties into the inflation and interest rate hikes. I wouldn't say it's really concern. People are curious because I think the numbers speak for themselves in terms of the economic activity that's happening in the state that makes us very bullish. And I think most people we talk to bullish going forward, but they are concerned. That's a concern. It's a little strong word. They're wanting to get different opinions of how the Fed is going to affect in the near and mid and longer term range with the market. And so we got an opportunity to talk with somebody today about multifamily, Avery Jordan from Franklin Street, which we'll have him on just in a moment, but wanted to first talk about a review, Stephen. Got a review.
We got a review.
And John from Miami writes, we love Anna. Anna Bozovich, I think, is who he's referring to.
Anna's always great.
And we love Anna. Bring her on more often to talk about the South Florida market. Anna Bozovich, we had her on about a month ago talking about, maybe it was a little longer than that, talking about what's happening in the market in South Florida. She has a lot of energy, and I think folks like listening to her, and she's our eyes and ears on the ground in the South Florida market. So we love those reviews. They help us tremendously, guys. If you've not done so already, please go to the Apple iTunes store and leave us a review. And that allows us to have an easier time to try to program our guests. Folks want to go in and look at reviews. They want to look at comments, what others are saying. Does it make sense for them to invest time with us? And that means investing time with you. So, John, we appreciate you taking the time to leaving us a quick review. And if someone else, if you haven't done so, please do so. Stephen, anything else before we roll into our guest?
It's time to roll in. Today we have with us Avery Jordan. Avery is a senior director for Franklin Street. He's a broker specializing in multifamily properties in Central Florida and across Tampa Bay. Avery was born and raised in Tampa, and he enjoys extensive relationships with apartment owners locally and throughout Florida. He has boots on the ground and perfectly positioned to give us a feel of what's going on in the apartment market. Avery went to the University of Florida, where he received a Bachelor of Business Administration. Avery, welcome to the Invest Florida show.
Hey guys, thanks for having me. Happy to be here.
No, Avery, we're really happy to have you on the show today. You know, I think San originally introduced us, but I think you and I have been communicating a little bit on LinkedIn prior to that, but met in person. San Ang had been on our show. Man, it's been a while now, talking about his investments here in Tampa. And I had a pleasure meeting you at his Christmas party. It's been, 6 months ago or close to it. You know, we talked about having you on the show at that time, and really happy that we're able to loop back around and get you on. Why don't you start a little bit talking about your background and how you got into doing brokerage of apartment buildings in the area?
Sure. So for everyone listening, my name, again, is Avery Jordan. I have been here at Franklin Street on the multifamily investment sales brokerage side for the past 6 years. You know, in that time, I've had the pleasure of working with now 5 other brokers on this team, and together we've done over 165 transactions and $1.4 billion of sales volume. And so it's been a busy 6 years since 2016 to 2022, to say the least. And Florida has been obviously a benefactor of all of the growth that's been happening in the economy and population growth and all of that. So definitely a good time and to be picking this career. I was born and raised here in Tampa, which is also relatively unique as far as, being a multifamily broker in the industry here, and have gotten to see the town grow up considerably. So after growing up here, I went to school at University of Florida and started here at Franklin Street really as an intern on the multifamily investment sales team, and I've worked my way up to a senior director here in a short 6 years. So very excited to be in this industry, in this location, and honored to be on the podcast with you guys.
So Avery, you are where the action is. When you look at the investment in commercial real estate, the multifamily world is by far the biggest attraction and of the most interest to people. So you're really where it's all happening. And give us a little overview of what's really going on, where the prices are going and how everything's being affected by the people coming down.
Yeah, and Avery, you've been really in the middle of one of the most aggressive price increases I've seen in multiple years of decades. Steven's been in the business he's on his second 200 something years.
230 years. Yeah.
It's like Methuselah. but neither one of us has seen the type of price and appreciation and cap compression that has happened over the last few years in apartments, and you've been in the center of it. So 6 years is almost like an eternity. Why don't you tell us about what's been happening since you got into the business?
Absolutely. Well, I wish I could tell you that I had researched heavily into what asset class I wanted to be involved in, and chose multifamily because of the strong tailwinds, and chose Florida because, of all of the growth that I saw in the future for it. To be honest, I lucked into it. I knew I wanted to be in commercial real estate, and I had a finance background with a real estate minor coming out of college, and really just took one of the first jobs that came available to me. And that happened to be in this multifamily asset class, which I very quickly was told by, seniors in the industry in other asset classes that was a very good place to be. So it happened to be the darling asset class of this whole real estate cycle, it seems, and very fortunate to have lucked out into that. But yeah, it's been an interesting ride for 6 years. It has been just a considerable amount of growth. When I started around October of 2016, I remember there were rumblings throughout the industry that, we could be at the top, right? There were certain sellers that thought there's no way it can get higher than this. I am selling out of my portfolio and I'm getting my cash on the sidelines ready for the correction. And that just was quite the opposite of what happened. So really, from 2016 to 2022 in Florida, it was growth in terms of rents, in terms of values for multifamily. There was a couple of hiccups along the way, and I would say probably the fourth quarter of 2018 is somewhat comparable to what we're going through now because that was the last time the Fed raised rates and probably the last time that we had an expired listing, because very quickly overnight when rates increase, all of a sudden the metrics that make a deal pencil out and make it attractive to invest in deteriorate overnight. So we're going through a very, very interesting period right now with the Fed raising rates twice in succession, 25 basis points and 50 basis points, hinting at, future rate increases on the horizon as well to tame the inflation going on. And it's causing quite a bit of challenges for all people in the industry right now, whether you're, a lender, a buyer, a seller, a broker. Everybody is dealing with it and having significant conversations about it and trying to wrap their head around, what is going on in the market.
Is it locking up the debt markets already, or are we seeing changes? What's happening on the debt side right now?
So locking up is a strong word, right? So I don't think the debt markets are locked up by any means. Right now, for the past 2 to 3 years, there's been such substantial rent growth in Florida, 25% year over year plus in some markets, especially for these B and C class assets, which I personally target, that everything has been going with bridge financing. There's been a host of national bridge lenders that have come out of the woodworks with very, very competitive terms. And for purposes of this conversation, we'll say it's 350 basis point spread over SOFR, which has become like the new benchmark rate for bridge debt. So what's happened is, the Fed has raised rates from 0.25% to 1% over the last few months. So that's a 75 basis point increase when they started out at 25 basis points. So that's tripling the Fed funds rate. And that doesn't necessarily equate to tripling the cost of capital because, like I said, that bridge debt is based on a 350 basis point spread above that. But that takes your bridge financing from 3.75% interest rate to 4.5% interest rate, which is a 20% increase in your cost of capital. So all of a sudden, the debt that you're using to buy this property, which is usually a big chunk of the capital stack, say 70, 75% of your total capital stack, is 20% more expensive. So overnight, the mathematical metrics that make that deal work and pencil out have changed. And, there are some other factors involved where, there's still a considerable amount of population growth to Florida. Rents are still increasing, and inflation is still growing at a good pace. So I think those are offsetting part of that. It's not like it's like a just 15% decrease in values overnight. No, there's other factors that play, but it's definitely making an impact. And we're seeing that on transactions that are being marketed right now. We're seeing that on proposals for the future. So it's going to take some time to work its way through the system and kind of settle down.
So you had mentioned 350 basis points over SOFR. For our listeners that might not be familiar with what that is, what is SOFR?
So SOFR is the secured overnight funds rate. I am not the quant math genius that's going to be able to tell you the formula for SOFR, but, on a high level, it is a benchmark interest rate, similar to the 10-year Treasury, LIBOR, there's SOFR. So somewhere along the way, in actual somewhat recent history, I would say maybe the past 12 months, a lot of lenders moved to SOFR as the benchmark interest rate. And it's something that we're watching closely. We have a forward-looking yield curve of what the market expects SOFR to do in the next 12 to 24 months. And we're trying to accurately price out deals in the future based on spreads holding constant and SOFR changing over time. So, it is difficult to understand what multifamily properties are worth in today's environment. When you have all of these pieces of the equation that are moving, rent's increasing, cost of debt is increasing. Within the cost of debt, you've got like I mentioned, just kind of, this isn't always accurate, but the 350 basis point spread. Well, maybe if rents go up, maybe those spreads can tighten a little bit down to 300. Maybe if it's an inferior location and a split site property, that spread's 400 basis points, right? So there's so many factors right now that I think it's sort of not paralyzing the debt markets, but maybe paralyzing the buyer market as they try to, scratch their head and figure out, okay, how do I make all this work now with these new inputs?
Are you sensing, similar to the 2018 when the interest rates increased, that sellers are starting to think that maybe, or I think you said 2016, but when the interest rates increased, that sellers are starting to think that maybe it's time to put things on the market? What's the anecdotal kind of conversations you've been having?
Great question. Yeah. So I am constantly taking a poll. My job is to be on the phone all day, every day. If I'm not on the phone, I want to be in a meeting, in person with someone, right? That's where I generate business. And, hopefully I have built out a team that can handle a lot of the administrative tasks, because that's not a good use of my time, right? So I'm constantly kind of taking a poll of the world, but through the lens of multifamily. It's funny though, during COVID, I could tell when cases were spiking because I'm talking to 100 people a day. And the more people I'm talking to that are, when 10 and 20 people start saying, I'm down with COVID, I know that there's a spike in cases, and then I'll see it on the news, right? So I am unofficially taking anecdotal polls all the time for everything. You are absolutely seeing a similarity to that 2018 rate hike that you mentioned, and you're seeing definitely some people, not all people, that are thinking, they're watching the headlines in the news and thinking, there could be a recession on the horizon. Let's sell. My personal opinion, and this is totally an opinion, I think that over the next 6 months, there is going to be an increase of inventory of available product on the market. I think that's going to be driven by exactly what you hit on there, which is potentially people trying to sell out before correction in values. I think also transactions are taking much longer to get done than they used to be for a variety of reasons. Third-party reports like environmental site assessments, appraisals, surveys, all of those have been taking much longer. They've been very backed up. But in addition to that now, marketing periods are longer. So, in the frothiest period of 2019 to 2021 in Florida, you could have offers, 10 offers in the first week of sending your new listing out to market. Now we're seeing it is taking a little bit more time because people are so focused on their financing plan and making sure they have that nailed down and making sure the deal pencils out perfectly. They're having more conversations with their equity. So it's just taking a little bit longer to get through the process, which I think is going to allow more available listing inventory to sit on the market at any given time.
So Avery, you'd mentioned that most of these deals are being done by bridge financing, mezzanine financing, and we're curious, what are some of the larger players in that area of financing?
There has been so many bridge lenders that have come out in the past 36 months to cater to all of the demand from the buyer pool that has been paying these compressed cap rates for properties with high amounts of loss to lease and, in need of a value-add business plan. So there are plenty out there, but just a few that I will mention that we've kind of transacted with and that we've seen have been very active. Arbor has had a bridge program that's, from what I understand, a balance sheet product, and it's a bridge to permanent financing plan where you go in with a bridge loan and then you refi out with Fannie and Freddie in 2 to 3 years, and there's some positives and savings there. ReadyCap, Lument, Bravo Capital. You've got some banks that have entered into a hybrid bridge-esque type space. So there's been a handful of national groups that have really, really gone heavy into it on apartments.
So one of the things that's happened, and just looking at the multifamily market and looking at it from the other perspective, but not from the investor, but as just people living. I mean, it just seems the golden rule used to be that apartments, or for living, you wouldn't pay more than a third of your take-home pay on living. And it seems now that people are stretching over 50%. And
particularly in our market in Orlando and Miami are like some of the worst in the country.
Yeah. And so I just wondered what your take on that, because is it really sustainable at that rate?
Yeah, that's something that a lot of people are starting to talk about as well. It's kind of another hot button topic, is the percentage of incomes that are being spent on rent. The formula, like you mentioned, was a third, so 33%. I don't have any actual data to back this up, but I sense that in our market, Tampa as well, that formula is getting a little bit out of whack for the workforce housing demographic as well. And that's a lot of what we sell. there are still areas where the average household income is, $35,000 to $40,000, and at roughly $35,000, I think you need to be below $1,000 a month in rent. In our lowest income workforce housing right now, one bedrooms that are 475 square feet are getting $1,100 to $1,200. So the formula has tipped. I don't know if it's quite 50% in our market yet. If I had to guess at it, I would probably guess it's around 40% for workforce housing here. But still, when does that change, and when do salaries and wages catch up with the rent growth? I don't know. I can speak for my company, and I've heard that other companies as well have done this. We went through last year, and for all of our administrative staff and support staff, we did a blanket 10% salary increase across the board, just a cost of living adjustment. And we're fortunate enough as a company to be successful and growing and be able to do that. You're hearing about minimum wages increasing, which is being phased in over time. So there are some measures that are going to increase salaries, but it is difficult when these people, they're getting increases to their salary and they're immediately forking it over in rent. Someone much smarter than me at HUD or somewhere out there is coming up with a solution to it, I'm sure. But right now, that seems to be the crisis is maintaining affordable housing stock.
Now, I know you guys are pretty focused on existing product, but do you also deal in the development market, Avery?
Very lightly. What's funny is I think every existing product buyer fantasizes about development, and every developer kind of fantasizes about buying existing product right now because the costs are
right.
through the roof, right? So it's just kind of musical chairs. In reality, for the most part, there's a lot of talk from each of those respective pools of people about doing the other, and then they generally stick to their core competency, whatever that is. But I'm somewhat familiar with what's going on in the development market, just not as in tune as a land broker or a shiny A-class broker would be.
Yeah, I just was curious what you're hearing from those guys, because it is a normal conversation that we have when we talk about multifamily, the development, that most of it that comes out is your A and super A-class apartments, and there's not much workforce housing going on. I didn't know if you'd heard any different, maybe you're hearing new projects that are coming out, if you can comment on that.
There are some interesting affordable new construction affordable housing projects coming out of the ground now. Depends on the municipality, really. I know St. Petersburg has done a really good job of incentivizing that and creating mixed income communities where, a portion, maybe 20% of the property caters towards people making below 80% of area median income or something like that. They've had some success with kind of public-private partnerships in that regard. They're also trying out, from what I understand, upzoning. That's being discussed where, you take a parcel that's zoned for single family and you allow someone to build a duplex or a quadplex on it if they agree in exchange to restrict who they can rent to an affordable housing qualified tenant. So there are some interesting projects going on at the municipal level. I'm not as in tune with it. From what I understand, the vast majority of new development right now is A-class market rate. Mm-hmm. And there's not enough incentives out there to satisfy, a developer to completely change their project and make it solely affordable when they can't charge higher rents. So there needs to be more incentives behind it.
Yeah, they almost have to do Class A development now because because costs have gone so high. It's the only way to get their margins up. They just can't come out on the affordable, which is really a societal problem. So, my perspective, just looking at the multifamily market as compared to other commercial real estate investments, is the reason you've been in such a strong position is that the leases on rentals are really only 1 year. So as inflation goes up, the landlords are pretty much protected. Whereas, on other classes of commercial real estate, or whether it's office, they'll sign a 5-year lease with maybe 3% annual escalations and things like that. So that's, from my perspective, why I think multifamily has been such an outstanding performer. It's just ready to keep pace with inflation.
Yeah, and continuing off that thought, there has been this explosive growth in a niche asset class of multifamily for short-term rentals for that very reason. Because for the multifamily, you reset every year, which is great compared to a retail or a commercial lease that has 5-year step-ups. But in the short-term rental space, you're resetting your rates daily, anytime. You can keep pace with inflation on a monthly basis or daily basis if you wanted to. And, generally you're renting at a much higher rent than a long-term lease would anyway. So you're getting a significantly more cash flow out of the property. That has gained a tremendous amount of popularity lately. And we talked about earlier about, how I'm taking a constant poll from the investors in multifamily. That has come up more and more, even to the extent where people are doing new construction, purpose-built, short-term rentals in and around an area like Tampa to capitalize on that.
Yeah, and that's probably the same reason that self-storage has had such a boom, because they can also adjust very quickly, and other asset classes just can't.
Yeah, self-storage has the benefit as well of being very non-management intensive, right? I think that's the one of the downsides to short-term rentals is generally your management fees, if you hire it out to a third party, are very high. You're almost like a hotel in terms of your customer service that you have to provide to your resident. So that is a negative, is the intensity of management on short-term rentals. Makes what you mentioned, self-storage, look even more attractive. I think what happened with self-storage, it was everything was so attractive about it that it was overbuilt in a way. And I think now we need more. So I think there's been growth, at least in our market, to support more self-storage. But for a while there, everybody was doing it because it was such a great investment for all the reasons you just discussed. And then it kind of tapered off a little bit.
Avery, how are you seeing, if at all, underwriting change over the last few years?
That is a really good question. Underwriting is constantly evolving. It is a fluid thing. When I started in 2016, when we underwrote deals, we underwrote it based on the in-place income with adjusted taxes. And there was a cap rate applied. Cap rate was generally, off the rule of thumb was maybe like 200 basis points higher than the cost of capital at the time. So whatever the interest rate was for multifamily debt, if it was 5%, maybe you were selling at a 7% cap rate, or that sort of formula. It was pretty simple. And then as our cap rates started to compress, as Florida got more attention, as Tampa Bay got more attention, and more investors started targeting this area, that market became more efficient, and those cap rates compressed. At the same time, the cost of the debt was getting cheaper as well. So, in an effort to make these deals work, everyone was getting creative, right? One issue I will say that came up probably 2 years ago and started to become a big deal was insurance. Property insurance in Florida, the increases that people were seeing started to really make or break transactions. And if you weren't showing up to the table when you're submitting your LOI with an insurance quote, you could be in for a pretty troubling discovery later down the road, during your due diligence period, or maybe your due diligence period passes, and then you get your insurance quote expecting it to be a 5% increase from what the sellers got. Well, it might be 30% of an increase.
Right.
And that has remained consistent over the past few years now, is we are getting insurance quotes on everything. I should actually go back and say, after that whole pricing deals on in-place income with adjusted taxes and insurance, then there became this market where our rents went up 25% year over year for a couple of years here during the COVID era, 2020 and 2021. We started selling cap rates at 3%, 3.25%, 3.75%, because there was so much loss to lease on the rent roll of these properties that it was an obvious play. Without putting any dollars into it, that 3.5% cap rate was a 5.25% just through turning over leases. And then there was a value add plan on top of it. So that was an interesting period. And I think now there are still some properties that are going to be measured in that very low in-place cap rate metric because of a big value-add swing. Most of the more stabilized or lighter value-add transactions are going to likely revert back to a scenario where it's priced on in-place income with adjusted taxes and insurance.
So just another way of stating the same thing. I think what you were saying is they were really basing it on what the projected NOI would be. And that's something we hadn't seen before in the market.
Well, we haven't seen it in a while.
Yeah.
We saw it in 2007.
I don't remember that far back.
Yeah. What are you talking about? Like 1897 you remember back to.
We have short memories, right?
Yeah.
No, but in reality, that's exactly what was going on. I wouldn't say that they were, people weren't necessarily pricing in the pro forma at this time because there was still a very defendable business plan. Even the best property management company, best property manager themselves, if they signed a lease 11 months ago, that lease is now 30% below market when it comes up for renewal the next year. That's crazy.
Yeah.
Without doing any improvements, you can get a 30% increase. So if you're looking backwards at a T12, or you're looking even at a current rent roll with lease start dates that happened 11 months ago, there is going to be so much built-in upside into that deal just based on kind of market rent growth and appreciation. Yeah. And so from an investor standpoint, if I can see that you guys have signed, your past 10 leases on a 100-unit property have been at 1,500, but a year ago you guys were at 1,000, well, I'm pretty darn confident that I can get 1,500. So I'm willing to pay up for that upside. And then beyond that, even the $1,500 units aren't renovated with quartz countertops and white shaker cabinets and vinyl plank flooring. They've got old ceramic tile and, cabinets from the 80s. So, I know I can get a $150, $250 premium above that. And then that's my, as the investor, that's my upside. So it made sense. It wasn't completely crazy, and totally buying off on projected income. I think there was an element of buying off on built-in upside into loss to lease that's on the rent rolls.
Gotcha. I know you got to run, and we've got to too, but I wanted to ask you one last question before we let you go. You do polls constantly, you say, of your investors and your clients and other buyers and sellers and developers and everybody else in the market. What are you hearing come up most frequently, and what is keeping those people awake at night?
I will tell you that most investors that invested in Florida since the time that I started in the business, they're not having trouble sleeping at night. They have done very, very well over that period. I would say right now what the general sentiment is of everyone that I'm talking to is that there is going to be a short-term correction while the Fed kind of raises interest rates, potentially oversteps in raising interest rates before they pull back on that. And they could not be more excited about the long-term prospects for Tampa Bay and for multifamily in Tampa Bay. They can't imagine a better place for their money to be invested in than apartments. And they're very, very excited about the long-term prospects here. So I know there's a little bit of doom and gloom when we talk about the current state of affairs with interest rates, and everyone's running around pulling their hair out trying to make it all work. But the general sentiment is very, very positive.
No, Stephen and I doing other asset classes, not so much multifamily, but certainly working in the retail and office and industrial classes, very bullish on the I-4 corridor. And there's so many of the investors that we speak to that are coming in from all over the country to want to be here, and there really is no better place. We believe that it's not just hyperbole, it's not just hype for our own businesses. It really is a consistent theme that we hear from our investors coming in from all over the place. Stephen, Avery was great. Is there anything else before we let him go for the day?
Yes. So Avery, if our listeners want to contact you or maybe talk about a deal, how can they reach you?
Yeah, absolutely. They can reach me via email, phone. They can show up at my doorstep. I am a broker, so I am always available. My email is avery.jordan@franklinst.com, and my direct line is 813-577-3826.
Avery, really appreciate your time.
Awesome. Thank you, Avery.
Likewise, guys. Thanks for having me on.
And that was Avery Jordan from Franklin Street, right down the street from us in downtown, Stephen. Downtown Tampa.
In sunny Tampa. So that was a really interesting perspective. And he's right, boots on the ground in the heart of a very strong market, but it's an inflection point. And it was a great time to have this conversation because interest rates are going up and buyers and sellers have to try and take it all in and adjust their strategies.
Yeah, I mean, the comment or what you hear throughout the market is don't fight the Fed. And we're getting a lot of questions about what that means. We're very, just like Avery, very bullish on what's happening in the I-4 corridor in Tampa. And of course, the Fed is going to have some effect on what's going on in interest rates. Inflation's having some effect on what's going on with interest rates. And there'll be some adjustments in the market, but nobody I'm speaking to, Stephen, are concerned about any kind of coming crash. A lot of these deals were written fairly conservatively. Debt ratios on deals are still relatively low, and there's a significant equity coming in on the deals. And there's so much economic activity in the I-4 corridor.
Well, there's more demand than supply. That's just the bottom line.
And that's why we're driving the prices and we're having such cap rate compression, especially in our area. Stephen Avery was a great guest. Love to have these types of very knowledgeable guys on talking about their asset classes. Where can listeners find other great guests?
The place to go is www.investfloridashow.com, where you can peruse our archives, but also download the app onto your mobile device so you can listen while you're on the road.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida Show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida Show.